Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, April 7th, 2020. I skipped a closing market wrap yesterday because I did got a video out and some analysis shortly before the close, and really nothing much had changed. In fact, I actually shut down right around the close. I didn't even realize until this morning that QQQ trade stop had been hit. I didn't have a price alert set to go off, but it doesn't matter. I do want to address that as far as, I did the update today, and as always, I want to just go over a few things that I said to some subscribers here. Let's go back to that one there. Let's go. Okay, let's start here under that SPY SPY trade I posted today. I want to go over these, the responses to some of the questions in the comment section on the homepage. And the first one here is from Nana. Nana, I am not picking on you. This is a great question. I'm glad you asked it. Nana asked, how does it make sense that you closed QQQ short trade? I think that's what Nana meant to say. And open SPY short trade. I'm not sure, a long short trade. SPY was a short, and maybe there was confusion there in the post. Again, I addressed that in today's video. I put out a pre-market post before this trade, making very clear my thoughts, my bias, my positioning. That despite the fact we popped above that QQQ stop, we still only managed to rally almost perfectly into my uppermost target on SPY, and as well as a significant resistance level on QQQ, and we're still well within average bounce retracement levels. Remember, do not, and this is a big takeaway, I feel very strong about this, do not get tied up in numbers. Don't look at how much the market has bounced and wow, a 20-something, 25% bounce. It's all about retracements. Remember, I've said this. If you're new to the site, you might not have heard me say this, but I have one term for the bull market from the March 2009 lows up until the recent highs, and that is supersized. Just like you go to McDonald's, say supersize my meal, you get giant fries, a big tub of Coke, and all that stuff. That's what this market was, and both the longest in history, one of the strongest in history, biggest gains. Therefore, and we've seen very big corrections, just like 2018, December, the fourth quarter of 2018, and 2015. So the more the Fed and all global central banks have injected the financial system with so much liquidity since the financial crisis, and kept their foot down on the gas pedal for way too long, in my opinion, and therefore they created this big bubble, this giant stock market that then has, as we're already seeing, this is so far the biggest drop of any bear market, even more than the one that started back in 1929, as far as how much we've fallen so far. So that's just one thing. Don't be fooled by or underestimate how far these bear market rallies can go, and of course how far down we could go on the next leg if there is another leg in the bull market. That would be the takeaway going forward. We've already now seen just how powerful bear market rally can be, and maybe there's more. Maybe I'm wrong, and that's why I spent a lot of time today. Most of my day was spent putting together the commodities video for you, and I've been actively updating and sharing those trade ideas. I like to just spread my bets. So maybe I'm wrong on the market, where we go from here, and hopefully if so, then I'm right on some of the other trade ideas that we have, such as some of those commodities. All right, so my reply to that, just real quick, is I wasn't sure if it was just, hey, how do why would you close a trade out on QQQ and then turn around and short SPY? Not sure if that's what that question was, but my answer was this. I'm a stickler on the official trade parameters. I have never, nor will ever, revise a parameter after the fact, meaning I will not change a stop after it's hit. That does nobody any good. Again, and of course these are suggestions, and I always say encourage you. Sometimes my tight stops are tight, and you might use a wider stop. Sometimes you might think my stops are too large, and it's beyond your risk tolerance, how much you're willing to lose on a stock. I encourage you to use the position size calculator to kind of put into exact dollar terms, if you enter a trade, how much you put in that trade, where your stop is. It'll tell you exactly what you're going to lose if your stop is hit. So that might be more or less for some than others because of their loss allowance and risk tolerance, trading style, what your price targets are. For example, some people like to, swing for larger moves, and there are more active traders that take a quick 2-3%, 4 or 5% on trade, and they get out and move on to the next one. If you're targeting 2-3-5% on trades, then you can't use a 5-6-7-8% stop. You need to use a 1 or 2% stop for those trades. So, but going back to what I was saying is, if I don't, and I will at times revise a trade once it's an official trade, once it's out there. Sometimes I will temporarily suspend a stop if I smell a potential stop raid coming that day and say, okay, I'm going to suspend it today. I'll put it back on at the close today or tomorrow. Sometimes I'll raise or lower a stop. And then same thing with price targets sometimes, and I did that on the QQQ short trade that we took down on the big leg down. I pulled in the price target a little early, closed that trade out early, and again, if you've traded, followed this site long enough, you'll know that sometimes I will modify a trading plan, but usually I like to see pretty compelling evidence to do so. I find it best to sit tight. If you go into a trade, have a plan. Always have a plan. What you're going to buy, where you're going to sell it, why you're buying or selling it, and where you're going to take profits if correct, and where you're going to take profits if wrong. In other words, your stop. And then if anything compelling changes, sure, you can make changes. But if you're constantly second guessing your trade every time it goes against you and wanting to close out or take profits early, I can just tell you that's not a good thing. All right, so let's move on. So anyways, and I also went on to add that, okay, yes, that one was stopped out because I did not send out anything in advance, nor am I sure if I even would have yesterday. What I saw in pre-market today really amped up my bearishness. That fact that we had that extra pop today, I had no doubt that yesterday saw a tremendous amount of short interest cleared out, and I'm going to talk a little bit about the fundamentals too today in this video. I also think it was a very misplaced rally. I think towards the end here, I thought we may have seen the end of the bear market rally when we shorted that last QQQ trade. We did get a 7% drop. Then they started flowing out this stuff about the peak of the virus coming soon, and I think I hope, I pray to God we do see the peak in the virus soon, but I feel adamant, and that's why I want to talk on my fundamental thoughts, that do not correlate or associate a peak in coronavirus with everything's okay, we're just going to go back to normal and the bull market will resume the previous bull and we'll pick back up where we left off and we'll get back to that point where the market just goes up. And no, I think too much damage has been done, and I could sit here and talk for an hour about all the different little nuances and fundamentals, the impact that things that have already happened, wheels that are set in motion, and probably at this point, with all the money the Fed can print, I don't think can be fixed. That's just my take now. Yeah, if the charts and the news convince me otherwise, hopefully I'll be able to recognize that early enough. But for now, sitting tight. Still think we go lower from here, especially in the near term, the very next couple weeks here, let's just say, if not more. All right, so that's it. On that QQQ trade, stop was hit. Since I didn't send out any type of revision or change to the parameters on the trade, that is it. That trade is closed out. And then I went on to say that I have no problem turning around, even if I'm stopped out on trade. I trade futures, so I wasn't in QQQ. I did have some ultra short ETFs and one IRA and some futures short and other retirement accounts. Interactive brokers will actually let you short in retirement accounts, unlike most other brokers. But you can only short futures. That's the thing. Or you can buy, of course, the ultra short ETFs. And so what I went on to say is, over the years, I've re-entered trades. To me, it's the motion. You trade long enough, the motion's gone out. If they stop me out, but a trade still looks good, the charts still look good, or I smell that maybe I was stopped out during a stop raid, short squeeze, anything like that, then I will go right back into the trade if the same case can be made. And that's exactly what I spent a lot of time in the post today on the pre-market post on SPY, as well as a follow-up post to short SPY. And then in the follow-up video today, I gave you my thought process and logic, so I'm not going to spend much more time on that. What we're going to do in the rest of this video is quickly go through the charts of the 11, not all 11, but most of the sectors in the S&P 500. I really want to show you where some of those are and how compelling they look right now. And on that, normally, the trading room is a place to put a chart request on something not covered on the homepage. But since I'm going to go over the 11 sectors today, and I do think it's compelling, Jay Newman 8 asked, an update on SRS. That's the 2 times short for the REITs. And so I'm going to go through the REITs are one of the 11 sectors in the S&P 500. So I'm going to go over that today in this video here with some others. And somebody else asked about the financials, and I've been covering that lately. We had a trade on the financials recently, and a long trade on the bounce. And so we'll get to that as well, because that is also a very important sector in the S&P 500. And then you can see somebody mentioned MNK. I highlighted that as a standout little small drug manufacturer that it popped today. Closed up over 17%, but it gave back probably half its gains, so it was up more than twice that. But it's still looking good. But again, we're not going to get into individual stocks here. There's just not enough time in this video. Let's look at the markets and the sectors that stand out, and we'll go from there. And kind of on that same vein, remember Will Hudd said XLV is looking tempting for short here. Gave, talking about a bounce into the death cross area. These MAs coming down together to moving averages crossing, and I said agreed. We'll take a look at XLV in a second. There's some key levels that it's up against. Somebody asked about, they mistakenly shorted QQQ instead of SPY. I just want to share my thought process in the reply to that question. I want to say, you can read it. It's under the post titled SPY Trade Update and QQQ Analysis. It was posted earlier today. And I went on to say that, other than giving a stop, that I do think there's a good chance that during the next leg down in the market, assuming we have another big leg down coming, whether it's very soon or let's say weeks or even months away, I said I think we'll start to see a lot of tech stocks, including the semis that have held up relatively well, to start finally coming under heavier selling pressure. And if so, then at that point QQQ could drop as much and possibly more than SPY. Remember, SPY fell harder on the initial leg down because tech companies inherently have less exposure to coronavirus. They're a lot of those tech companies, cloud, they're in the cloud, they sell software, they don't have retail stores, they're not restaurants. And QQQ is about half tech stocks, and it lacks a lot of sectors such as financials that got killed on the S&P 500. It has almost virtually none. It's like a 0.3% allocation or holdings in any financial related companies. And so QQQ is really just even though it's an index, call it a tech fund, if you will. And so I do think that will likely come into play going forward. I think right now people flocked and held on to tech companies because they don't think they have that exposure. But the play that I'm looking at going forward is more of a recession play. And you see a turn in the business cycle. Tech stocks are growth companies. High growth chip stocks, everything's doing well. Tech's booming. They're selling a lot of chips. All of a sudden, demand goes, and as I've gone over many videos, when the semis finally peak, it's about usually 50 to 70% bear market that they look at once they've run a cycle. And I'm talking the tech sector as a whole, and the semis are sort of the canary in the coal mine for the tech sector. So I just wanted to point that out, that QQQ, SPY, DIA, they're all going to go, give or take, they're going to run in line with it. So a QQQ short's fine here as well. I just went into SPY this time around because it had hit that target that I was looking at. What else did I say here? One other thing I wanted to cover. All right, this member G Thompson 333 mentioned he has enough toilet paper for the next 10 years. And I want to say exactly. So here's my fundamental thoughts. Tons of shelf stocking are going on over the past month, creating a near-term boost in sales of mostly low-margin items. Think about it. What are people buying right now? What are they going out and buying a new RV or Harley Davidson or Ferrari or a Gucci handbag? No. What they're buying right now, what we're seeing a surge in, are low-margin, low profitability products like toilet paper and hand sanitizer. They're not going to boost GDP, and they're not even going to help offset the drop from large ticket items. This is what drives GDP. Auto sales, boats, trucks, RVs, planes. You think Boeing and all the other airline makers are going to have any type of any way to spin this as positive for them? No, I don't think so. With what's going on, because again, even coronavirus, let's just say an outright vaccine comes out next, and that helps. Okay, is it going to be gone? No. Just like the flu, every year there's a vaccine. They have a tough time every year, because I've read this years ago. They have to start working on it like 8 months out in advance, try to guess which strands of flu are going to be out that season, because you get it once, you're going to get it again. You could build immunity, and then there's always different variations, and more so people are going to start going forward. All these movies like Contagion, and well, what was that other one with Dustin Hoffman and Cuba Gooding Jr.? Those movies that have been around for a long time. People have been warning. Smart people have been warning that this wasn't just a maybe, but an if. Where I'm going to go with this is that, okay, if coronavirus went away a year from now, people are always going to be worrying now going forward, because of what this did, about piling onto crowded aircrafts, planes, and so I think it's going to have a lasting impact for many years to come, on really the economy, and things like that. So those are just fundamental ramblings right now, and I'm going to get into the charts here in a second, but. I went on to say that I believe, other than the technical conditions that preceded and fueled the recent rally, excessive short interest, put-call ratios, forced liquidations, extreme oversold conditions, bullish divergences, etc. These are everything that I highlighted, 3-4 weeks ago. That was the technical, meaning the charting, things that go in technical analysis. That was the catalyst for the bounce, and the fundamental driver, more recently, I think, has been what I think is a gravely misplaced belief by the general public that the projected peak coronavirus somehow means it's going to be behind us completely, and we're going to have the market explode just as it did back in December 24th at the lows in 2018. Remember, we had a V bottom here. I'll go over that for those of you that are new to charting and investing. This is what a V bottom looks like. And they're rare, but they do happen. And we've had a couple in the last year. So what I think is going to happen here, what I think it may be in play, is recency bias. Recency bias is one of the many biases. There's quite a few in trading that apply. Well, it applies to anything in life, but in trading and investing, recency bias is the belief that when you see something happen, especially when it happens a few times, that it's going to continue to happen. So we've had quite a few V bottoms in the bull market, and maybe that's what this is. So I think there's FOMO trade the last couple days here, fear of missing out on what might be the biggest V bottom in history, and I can tell you, I can't tell you if the bear market rally is over. I can't give you any guarantees, but I would put the probability of seeing these recent highs in the market anytime soon, anytime this year, as very close to zero. Let me just put it around 3%, in my opinion, if that. The only way it's going to get there if the Fed just comes in and just takes this stimulus and magnifies what they've done by 10 to just really pretty much gun the system, and print it so full liquidity. But that's not going to happen. There's limitations to what they can do. So let me just say that I don't see this V bottom. At best, this market has some tough sledding for the rest of the year, and believe me, I hope the economy gets back on track sooner than later, but I'm going to go over the charts right now and tell you why I don't think it will. Finally, one last question I want to share, because I think it has value for everybody here. Somebody asked, how would you project the targets, price targets and stops on the SPY short trade to SH for the leverage versions, or for the leverage version. So SH, remember, in this post today on the SPY short trade, I said there's other ways you can go about shorting the S&P 500. You can buy a SH, which is a non-leverage inverse, so it shorts the SPY 1-to-1. SDS is 2-time leverage short, and then SPXL or SPXS 3-time leverage short. Now, That's just three right there. There's a ton of ETFs out there: leverage, non-leverage, inverse, non-inverse. And when I'm busy like this, I can't possibly look at each and every one. It takes a little bit of time to go through and align price targets on different charts that have completely different price scaling, account for the leverage and everything else. But I just want to say there's two ways to do that, regardless of which ones you trade, whether they're inverse, not inverse, leverage, non-leverage, 1, 2, 3 times. You can number one, use align the support and resistance levels, which are key reactions. Look for the top and bottoms of candlesticks on certain days, trend lines, etc. Align those to the chart of the short or leverage ETF that you're using with the same levels on the 60-minute SPY chart I'm using. Most importantly, make sure that you use log scale. I use log scale on my 60-minute charts. So if you're not using log scaling, there's setting on most charts, either linear, sometimes they call linear arithmetic scaling, and log is also known as semi-log scaling. That's what I use, and over time, especially if there's big moves on the chart, you'll get a different technical picture. The levels are not going to align. Trend lines especially won't align. The horizontal levels should, but the trend lines won't. So make sure you use that, and B, make sure you compare it. If you're going to use, let's say, SDS, you have to pull a 60-minute chart. Otherwise, the candles aren't going to look the same. The trend lines might not line up as well. So that's how you do it. And the other option, number two, is you can either manually calculate the distance to those targets. Again, I won't read through the whole thing here, but you guys can read that. That's the other way. I'll show you right now what I'm talking about here. So you go to SPY, and this morning we shorted it somewhere right around the highs. So one way to do this is, okay, you take it right here, wherever it was. I did this earlier. I put my cursor about where that short trade was posted at, and I ran it up here, and it was about a 2.25% move up to the stop right there. So you have about 2.25% to the stop is hit from where the trade was entered, down to about a 10% profit if the T3 was hit. So therefore, how to correlate that is you go to SDS. I also mentioned that all the charts that I post on the front page, they're time stamped. It's in the lower left-hand corner, so you can see, exactly where SDS. You can go down to a 1-minute chart to see where it was trading at the time we opened today. But let's just go back to that 60-minute chart. So here's the open right around here. So that would have been the comparable entry. So for a stop, you just drag this line. You can see my pop-up box to the left in the very bottom there in red. It's showing the percentage loss. So now this is 2 times leverage. So instead of a 2.25% loss, I need to make this a little bigger and allow for a 5% loss. Because remember, you're only going to take a half position size, and so that's a 5% actual loss is only a 2.25 beta, or I'm sorry, 4.5% is what I need to hit here. That would be it, right about there. Call it about 25. That would be your stop, comparable, and then entry price would be, instead of 10%, you just go up here for a 20% gain. And that would be somewhere right about there. And you can see it lines up with that resistance right here on SDS. So that would be your level right about 31, 34 or so. And of course you can do that with any of them, SPSX, SH, etc. Okay, so now let's dive into the charts. I spent a lot of time talking about technicals, other little things to consider. So here's the SPY trade, and again, it was entered right around the open there. So far so good, but really nothing to write home about. I don't know. I didn't even have time to got that out early. Didn't even set alerts. Did we hit the target? 63.25 is T1, and we hit a low of 63.65. No, not yet. So we haven't hit T1, although we probably hit it in the after-hour session. If I turn those on here. Yeah, it's already on. Maybe not. Okay, so that's going to be T1 if it gets hit tomorrow. T2, T3, T4. Divergence right now. What's changed? We do have a lower peak in the PPO, so that helps to confirm that divergence. It's a little more downside here. We'll get a clean bearish crossover on the PPO. Let's look at the daily chart. Or no, let's flip back to that 30 minutes. See, there's that T3, and that was laid out all the way back here. and maintained, throughout this whole thing. Although that's where it looked like we might have fallen shy. That again, that was a maximum bounce target. And so we didn't. And again, I went over that earlier today. So far so good. The fact that we've seen not just a reversal there, but an impulsive. Look at the selling so far. Look at this string of red candles, all red candles here on the 30-minute chart since we hit that level earlier. Came in, even made a second test of it. So we popped it at the open. That was an objective short. Popped it again. Gave anybody a chance that didn't get the email right away for another objective entry right around that level. And again, let's not get too excited yet because there's plenty of work to be done. But I do like where we're at there. On the daily chart, you can see that we hit really good resistance. Let me turn everything else off here and just show you this line right here at about 273. Again, that was T3 on the. You could see the resistance on that 30-minute chart I showed you, but this is a pretty big level on the S&P 500 right there. Some key reaction lows, and again, I think I put up earlier. Let's see if we have some Fibonacci's for you. I did that earlier today, and it was QQQ that had hit the 50. We have a little bit more to go before SPY. SPY's a little shy of the 50% Fibonacci retracement level, but QQQ reversed right on the 38.2%. Nope. I have to update this chart. We hit a fib today. I know we did. There it is. Okay, there's the fibs. I had them on this. This is an old board here. I've got a lot of different boards. 50% Fibonacci retracement level right there, and then we reversed off that. And when we look at price resistance, this is a nice level here. You have this uptrend line from June of 2019 coming in right there. We hit it there. We had at least 3 reactions, actually 4 reactions on that trend line right here. Reaction, 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 reaction there. Broke it, and now this is simply a back test. That's just an old trade. That's when we went long right here, bounced up, took it up to there, and then we turned around shortly after that, shorted, rode that down to there, and then had unofficial longs here until recently. And I want to show you one more. Let's look at IWM before we move on. And what I really want to look at on IWM is a weekly chart. You can see IWM is, IWM's small caps. They've been in a bear market since back here. We had, just like on the major stock indexes, these big divergent highs. This was negative divergence building for a couple years there, played out right here with that rising wedge, and that did it. That one divergent high, we had one back here, and that was a big correction back there. It was double digit. That was probably over 20% drop. It was over. I know it was over 20% drop, 2014-15, and this one did it. And we had a kickback rally, very convincing, but it fell shy of that all-time high, and then boom. So this is where the bear market started in IWM technically back here, or you can call it, if you don't want to split hairs, close enough to those highs, called a double top back here in back in January. But when you look at the move down so far, and remember, although this is a weekly chart, the technicals work the same whether you're on a 5-minute chart or a daily chart or a weekly chart. And what you see here is a very clearly impulsive move down, all red candles on this weekly chart, followed by what appears to be a nice, clean bear flag pattern. And so if that plays out, and it could play out easily because this is my longer term target down here, 86.35, that would project. It would project a little bit beyond that, but that's where I'd look to cover any long-term short positions on IWM for a likely bounce. That's about 28% below where we just peaked out this week on IWM so far on the weekly candle. 27, call it 27% right there. And again, so what you want to see now for a bear flag, it's only a potential pattern depending on a sell signal, and what you need to see is an impulsive breakdown below there. So we get a impulsive move down this week or next, and we get a solid red close, then that's your sell signal there, and you may see another impulsive leg down. And if we are in a bear market, the Fed's trying to distort this one and foil it just like they did the last one. But typically, let's say they're unsuccessful, which I believe they will be ultimately, unfortunately, those things usually play out pretty fast. The way bear markets work and bull markets, they wait till sentiment gets to extremes. They trap the what I call the Johnny-come-lately shorts in right here. As I said back then, it was not objective to stay short or to be short, but those that did, they got squeezed out. They felt the pain. Now they're convinced. You have people that started buying. They weren't not a lot of people buying here, but they were buying here for sure. And then the same thing happens in reverse. So that's really the way I see it. It's a big pendulum swinging in a bull and bear market, and you almost have to kind of trade that, the ebb and flow of that, the sentiment. Everyone's bullish up here, very bearish down here. They start changing a little bit here and start to get bullish here, thinking the worst is over, and you need that, because only when you have a lopsided, a one-sided trade with most people bullish, most people long, shorts being squeezed out, given up, that's what opens the door for those quick moves down. When you have very high short interest and excessive pessimism, it puts a floor in that really makes this hard to come by. And so I think we may have cleared out enough short interest to get that, but we'll see. We'll just take it one day at a time and see where we go from here. I just wanted to point out that potential flag, because that's some pretty ugly stuff. All right, now we will quickly rifle through the 11 sectors of the S&P 500. Tech, like I said, QQQ of all the sectors out there looks the best, or the major indexes, I should say. And the tech sector is strong, but when we're looking at this weekly chart, we can see that XLK has just rallied up to this is a level I've had on this chart for a long time. Created this line back on March 10th. Let's see. Take that back. I have different boards, but it is a level. It's a reaction high. I must have just put that one on this board recently, but it's a pretty significant level. You see reaction there, and we dipped on down through there, hit this long-term trend line right here. You can see this bull market trend line that comes in. Comes all the way back here from 2009. We hit that, and I could even take that down a little, make it a little tighter right there. In reverse, and we bounced right back to 82, 84. So I wanted to make a point that this sector, this is the largest in the both the NASDAQ 100 and the S&P 500. So it's very significant. And you have, if you can see these lines on the chart, and I think I covered this yesterday, you have a confluence of key moving averages. Up top, you can see they're color-coded. The red line's a 200-day exponential moving average, the blue line's a 200-day simple moving average, and the yellow line is the 50-day exponential. And if you have the brightness up on your monitor, you can have them tuned down a little bit here so the chart's not too busy. All three coming in right there. And so you just had tech run into a confluence of moving averages. And why is that important? Well, a lot of traders watch the 200-day simple moving average. A lot of other traders watch the 200 exponential moving average, and then yet others watch and trade off the 50-day. And you can go back on your charts and see you get a lot of reactions on those lines. And so they're all converging, and that's where we popped. In addition to that price resistance, and we failed there so far. Pretty impulsive reversal, you can see from top to bottom today in the tech sector. Here it is. There's our pop up at the open, and they faded tech down into so far in the after hour session to the tune of about 5.25%. Okay, remember that's our leading sector. Has led the entire bull market on the way up, and so far on this, it's held up relatively well for all the reasons I mentioned before. But you want to keep an eye on this one, because I've always said when tech breaks, the market breaks. There's just no other way around it. It is too large and too important of a sector, especially its large weighting, to have the market continue to rise if tech falls. So we're going to watch this one closely, and I do think it will, start to feel the pain of, the consumer cutting back. All right, next up is XLV. That's what member Wilhud had mentioned. And so here's my XLV chart. This one's a little busy, but bear with me. I'll show you the salient levels here. You have the trend line right here, uptrend line support. Nice reaction there, big reaction there. Bounce there, and we had a sharp bounce off it that proved that was still, or confirmed that was still an important level. We hit it there and went 1, 2, 3 days. If you zoom in real tight, you can see 1, 2, 3 successful defenses. Look where the candle closes. Look at the body of it. So one, and that green candle hit it and it had an explosive rally off it. And then once it broke, boom, gap down, ran out of back test of it, failed. Where are we at now? We tried to regain it today, rejection. So that is a failure at resistance, not just that trendline resistance, but you also have a nice resistance zone right here, those two price levels. And so that looks about as an objective shorting entry as you get right there. And so, I will say, and there's also the confluence of those three moving averages there as well. You can see, just make them out there. So I'll go on to say that, yeah, if XLV can power on through and hold here, sometimes you get a day or two where they pop and then fail. But, the farther it gets away from this trend line and that resistance zone and those three moving averages right there, then the more that chips away at the bearish case. Otherwise, this has been a very steep ascent, and from steep ascents usually come steep descents once the trend line breaks. So you might draw that better on a 60-minute chart. But there's XLV, second largest sector in the S&P 500. So this is the importance I'm trying to impress here. This one's a 14.2% weighting. These weightings may have changed. I haven't updated them lately. And then the tech sector is nope. XLK. Tech sector is 23. So those two alone, healthcare and tech, you can see make up, about over 40%, close to 40% of the S&P 500 returns right there. All right, now we go down the line. Financials are certainly a significant sector in the economy. I don't know if they're still making up a 13% weighting, but the Fed's supporting. The Fed has their back. And from a technical perspective, this is a 60-minute chart. It's looking very similar to the S&P 500. You had this divergent high right here on the 60-minute right there, little minor trend line right there, which broke down, and some support levels. I just don't know how much more they're going to go down because, again, the Fed is, and they've come out and said it with, not trying to mix words. They're going to do whatever it takes to support the financial system, and that's first and foremost the banks. People don't like it. The big banks, create a lot of this mess. They certainly created the financial crisis back in 2008, but they're too big to fail. So right now, do I think they go lower if the market does? Yes. Will they drop as much as they did before? I'm not sure. They really can't go too far. The whole system breaks. So let's just say I'm going to fry other fish right now. Keep an eye on that. And you saw the levels. If you do want to take a short trade on it, those are some near-term levels. And bullish if it can pop above this next resistance, 2256. Doesn't mean it's going to all-time highs. There's still plenty of resistance levels ahead. And that's the part about this your market. It's not smooth sailing to the upside. Even if we do continue higher, there are big resistance levels still ahead for most sectors as well as the broad market. All right, XLC communication sector, that's a 60-minute chart. There's resistance there. Let me see what I have on the daily. Not much. I'll tell you, there's more upside before resistance. I don't see any resistance, really, any significant resistance. There's some minor resistance there. That was this right here, where those 3 days, remember, I keep focusing on, where a lot of sectors and indexes had defended key support levels, trend lines, or moving averages 1, 2, 3 days, and then broke down. So that is technically significant, and I put a line there. Other than that, you have a much better defined resistance level right here at 47.77, and then the 50-day coming in there. The 200 days are both up here, and the 50 days right around that 47.77 level. So let's say at best this week, if there's any more upside, this sector might have about 3.25% upside till it hits very significant resistance at which it would offer an objective short entry. XLY, consumer discretionary, big rally there as well. Again, this is, I think, a misplaced rally, but in the belief that just if we peak out on the number of new cases, that all of a sudden people are going to go back to buying Gucci handbags and Ferraris and all kinds of stuff that make up the whole thing of consumer discretionary spending. Remember, you have consumer in the S&P 500. You have consumer staples. These are things you need. This is soap and toothpaste, and then you have consumer discretionary, things you don't need, things you buy when you have discretionary income. So that's again a sector that probably has a lot more downside to come over the next year or so. There's your similar type bear flag setup on the weekly chart of XLY, and where might it go before all is said and done? I'll have to sharpen my pencil and take another look at this chart, but at least revisit. I think a retest of the recent lows right there, about 82.12, I think is certainly possible. And from this, today's high or this week's high, that would be about a 22% drop to test those lows. And it wouldn't surprise me to see us come down to that other level here, about 74.78. All right, a few more to go. XLI, industrials. They've rallied back to a significant resistance level. They're a little bit above it now, but wouldn't surprise me if this is what I refer to as a momentum-fueled overshoot. And that level, I don't know why it's not showing here, about the $59 level. It has regained it right now, so technically speaking, that's bullish if it's not just a momentum-fueled overshoot. If it can hold above that level, in other words. Let's see what it looks like here. I don't have much on that daily chart, 60-minute chart. I do see some pretty good resistance right here. I didn't have this chart marked up, but there's a big old gap right there, and that's resistance. Is that an inverse head and shoulders pattern? No. There was certainly divergent low. All the same technical setup that was the bullish technical posture that was the catalyst for this rally and everything else right there. I was just trying to eyeball that and seeing if it looked to be what we call an inverse head and shoulders bottoming pattern, but I can't really make out a clean. At best, I can force it like this. It's not very symmetrical, but that would be your left shoulder right here, head, right shoulder, and then a breakout, and so it's possible. And the thing is, if it happens, the key is just not to stay short during what could be the measured target for a inverse head and shoulders pattern is the distance from the head to the neckline. That'd be about a 32% rally, so you don't want to ride out 32% short. That's XLI. Again, not that I have a position in that particular sector. There's XLP, consumer staples, and yeah, you need them. This is the toilet paper everybody's buying, things like that, but rally right back to resistance. And make no mistake about it, although consumer staple companies are defensive issues, think Procter & Gamble, Colgate, Palmolive, those type companies. You need them. You keep buying their products, during thick or thin. However, make no mistake about it, during a bear market, they go down as well. And last time around, XLP dropped 36%. So you were much better off, and as you should be, in a defensive sector like consumer staples. You only lost, quote unquote, 37% of your money off the top, instead of the 55% in the S&P 500 and a much bigger drop in the financials. But here's the bottom line: they have rallied back to a very significant resistance level, and that's why I spend all the time doing this video, showing you not just that the S&P 500 rallied into resistance, but when I can make a case that 11 or the majority of the 11 sectors in the S&P 500 also on the same day hit some pretty significant resistance levels or are very close to it, that then strengthens the case that, hey, this is probably a near-term stopping point. And it also opens the door. Look, if I'm wrong, because like I say, resistance is resistance until unless taken out. So let's say we just had a little reaction here, whether it lasted just one day today, or we pull back and consolidate and then take it out. These same levels that I'm covering right now, that we so far stopped or checked this rally today, the day isn't over. I mean, the week isn't over yet. The week is still early on, and these are weekly candles. So let's see how we close here. And at the end of the week, if I'm doing this video on Friday afternoon and I see a bunch of big red candles, big reversals off this level, I'm going to say that's pretty darn bearish, and it helps to affirm the the case, or strengthen the case. There's probably more downside to come. However, if we close up some big green candles and we close right up above there, solidly above not just XLP but the majority of these sectors, take out those resistance levels, those moving averages, and everything else, then it's hard to spin that as anything but bullish. And although I'm following the headlines closely, you often hear me say that the market will often lead the news. It knows what's going on ahead of time. The stock market looks out quite often 6 to 9 months ahead. Right now we're in a much faster moving environment as far as news and changes in fundamentals go. So they forget about 6 to 9 months. We're looking now 6 to 9 days, if not 6 to 9 weeks. So yeah, we'll continue to watch that. But my point is, if what would cause such a rally? Well, we probably wouldn't know for a few more weeks. There's something going on under the surface, whether it's something with the government, something with coronavirus, or a combination of all that that would lead to such a rally. So you just have to be open to all possibilities. But the charts tell me pretty clearly there's probably at least another wave down coming here. All right, a couple more. Energy sector, left for dead. But rallying lately because of crude oil, and I already covered that in the commodity video today, so I'm not going to spend time there. I don't see really a trade right here. There's a big gap resistance right there, and it's not going to move the needle. I'm trying to do this video to talk about really to support the case for the short on the SPY trade, and some of the other ones that we have too. But this one this was a while back. It was a 4.35 weighting. That's probably reduced since then with the big drop in the energy stocks. And then XLU, again, utilities are not going to move the needle. They are a defensive sector, meaning they tend to do well during a recession, or at least hold up, because as tough as times might get for you, you lose your job, you're probably not going to quit paying the water bill and the electric bill. You'll probably cut out Netflix before you cut out Florida Power and Light or whoever your utility company is. So that's why they tend to have more consistent earnings through economic cycle, economic contraction or recession. And then XLRE is the S&P version, but I like to use IYR because it's been around longer. That's first to market REIT ETF, and just rallied right into resistance. This was one of the questions I had today. Boom, boom, boom. That was a key level right there, and we went through there. We failed at it recently in this rally, and we popped up, hit it again today. Popped it intraday, but effectively closed right back on it. So you have the REITs at resistance, and you can see it on this weekly chart how clear that resistance level is. So yeah, I think it's an objective short here. Now the thing about REITs are there's many different types. There's hospital REITs. They're probably doing good right now. You have apartment REITs. You have all kinds of different REITs, shopping malls, things like that. So they're not all one size fits all. And you might do better off sniffing out. And if I have time, I'll try to do it. Those REITs and different sectors of the economy that are going to have a bigger impact. I think the apartment REITs. One thing I read an article and some landlord pleading. People are going to take advantage of this. It's sad but true. There are people that a lot of people losing their job. I was watching. My wife was watching The Voice last night. I walked by. They have an intro. There's a poor 18-year-old girl from Georgia. And remember The Voice is filmed in advance. She works at the same restaurant her mom and grandmother and her sister work at. So I'm thinking, wow, what hit me immediately, and again, this is pre-recorded before this all happened probably. There's 4 people, and actually 3 generations of a family right there that have probably all lost their job right now. And so, you're going to see where I'm going with this is apartment REITs. They're probably going to take it on the chin. There are people that can't pay their rent, and there's also the whole subset of people that are going to take advantage of it. There's a lot of landlords some that are waiving or allowing deferrals on rentals, but they're going to take a big hit. So we'll look at those later. Too much to get into this video. It's been going too long already. We'll probably wrap it up here. There's only one more sector in the S&P 500, and I'll just end it there at XLB. That is basic materials, and there's your chart. There's some resistance there. I'm not, this one doesn't move the needle in the S&P 500, so there's really no point spending a lot of time on it. It's such a small weighting that it's not going to really make an impact, but it's at resistance right there as well. That's it. We'll wrap it up here. Long video, but again, I wanted to do a thorough analysis. And these levels, like I said, they can go the other way if we break through them, and we keep moving up. Maybe there is more. Maybe the rally has more legs, but as of now, like I said, to me this looks like one of the most objective shorting opportunities I've seen in quite a while. So that's why I put that SPY short trade on, the morning after the QQQ trade was stopped out. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.